is basically the Form 3CEB, the actual CA certificate. Now, when you look at Form 3CEB, I was just wondering whether a lot of these countries have such kind of formality of a CA coming in and signing and giving that comfort to the government. Very frankly, India is the only country where there is a requirement for a CA to certify something on the volume and the nature and the method for the transactions. There are disclosure requirements in all the countries, but most of the disclosure requirements are part of the tax return where the company has to fill in the data and the numbers and everything. I think it's a typical habit of the Indian government to expect CA to as a kind of a go-grade or between kind of a person, so that they completely don't take the responsibility for the assessees or the taxpayers' accounts, and they kind of put the onus on the chartered accountant to certify some of these things. So, very few examples or hardly any countries you will find where there is a requirement for a CA to certify something, and that is where India is very unique and very different, and therefore this Form 3CEB, especially when you talk to foreign companies, etc., it becomes very difficult to explain that it's not a tax filing per se, it's a CA certificate. Although it's a part of tax, but it's a CA certificate. So the role of a CA is like an auditor, where you actually kind of go and audit the books of accounts and come out with the conclusions. So what I'm going to go deal with today is the entire legislative framework around Form 3CEB. The new Form 3CEB, which was notified last year. So whether it has thrown any surprises, what is the government's thinking on the new Form 3CEB? Issues related to e-filing. Whatever said and done on the e-filing side, there are so many teething issues, there are so many troubles, people were complaining a lot in terms of this is not happening, etc. But frankly, e-filing has done wonders, the government has done wonders on the e-filing side. They have kind of revolutionized that part also and given a lot of comfort to taxpayers. And in turn, they have saved a lot of manpower at their end also. So e-filing, whatever issues are there, government is kind of positively looking at that and solving one by one. We look at some of those issues. We look at what is the audit element in the entire transfer pricing, because transfer pricing and audit don't go generally together. Transfer pricing is an economist's job. In India, we chartered accountants are doing it, but abroad you will find economists and MBAs doing transfer pricing, not chartered accountants. So what is the audit portion in the thing, and what are the practical issues around it? And last but not least, how to kind of save ourselves by taking proper representation. So on the legislative framework side, basically you would have kind of gone through this, understood this, that whenever there is transaction between two associated enterprises, if the transaction is on a cross-border side or an international transaction, then transfer pricing provisions becomes applicable. Or if there is a specified domestic transaction between two related parties, then transfer pricing provisions becomes applicable. And this specified domestic transaction or domestic transfer pricing was introduced somewhere in 2002. This history, there is a separate session on domestic transfer pricing, so I'm not going into all that in terms of the history behind domestic transfer pricing. But the idea is that the entire transfer pricing revolves around transactions between associated enterprises or related parties, be it domestic or cross-border. And essentially there are three leaves, as I put it, in transfer pricing. One is the arm's length price. You need to determine what is the arm's length price, or you need to justify your pricing. The second part is the documentation part. You need to justify or you need to determine the arm's length price by having appropriate documentation in place. So the documentation is the second part. And the third part, as I mentioned, which is unique to India, is the accountants' reports or Form 3CEB. So in the language, in the Act, etc., they use the word accountants' report. So that's the third part of it. Now, when you look at arm's length price, it just kind of revolves around 5 methods or the 6 methods. The sixth method is actually n number of methods put together in that 6th method. So arm's length price kind of revolves around how to determine that based on the methodology defined into the Act. Documentation is kind of maintaining the prescribed documentation and justifying your arm's length price. In the accountant's report, kind of the emphasis on true and correct. True and correct information of the intercompany transactions. True and fair view of the most appropriate method. So the accountant reports kind of revolves around those parts. Very summarily, when does one think of Form 3CEB? Form 3CEB would get triggered if there is an international transaction or if there is a specified domestic transaction exceeding 5 crores. it's issued by a chartered accountant appointed as a transfer pricing auditor, if you would like to say that. The due date is 30th November. Where there is a separate date for transfer pricing, specially carved out under the Act, saying that if you are following transfer pricing or if transfer pricing is applicable to you, the due date gets relaxed from 30th September to 30th November. And there is a penalty. The first penalty of ₹1 lakh for file the Form 3 CEB, which was always there right from day one. And last year they introduced this another penalty for failure to report a transaction in Form 3 CEB. So if you miss out reporting a transaction in Form 3 CEB, the penalty is 2% of the value of the transaction. And again, a very unique feature of India in terms of the penalties as a value of transaction. Again, nowhere in the world you will see penalties as a value of transactions. They generally as a part of the tax, or as a lump sum amount, or for some number of continuing offences, etc. But linking to the value of the transaction is again a brainchild which India can only kind of come out with. So what does the new Form 3 CEB talk about? What I am going to do is I am kind of going take you through the Form 3 CEB, various clauses of Form 3 CEB. What are the issues that can come across in each of the clauses? What should get reported in each of the clauses? And what is the difference between the old and the new one? During my talk, I am going to kind of briefly highlight that this was not there in the old form or something like that. So section 92E governs the issuance of Form 3 CEB or the accountant's report, read with Rule 10E, and basically it is applicable for any transaction. In case of international transaction, above ₹1 itself. In case of domestic transaction, above 5 crores. So there is no threshold for applicability of Form 3 CEB or applicability of accountant's report for an international transaction. Even a ₹1 worth of transaction, the Form 3 CEB will get triggered. And even if your transaction value is say 1 lakh paid up capital, now the capital is also introduced under the Form 3 CEB clauses, or the definition of international transaction, the kind of Form 3 CEB straightway gets triggered. And even for a nominal compliance is of 1 lakh, the company would have to incur fees on the accountant's report or chartered accountant's report in Form 3 CEB. It applies both to residents and non-residents. This is one of the again major belief amongst people that it is applicable only to Indian companies. It is equally applicable to foreign companies because it's the section 92E, which is the governing section for the accountant's report, says that any company entering into an international transaction with an associated enterprise, it has to file a report in Form 3 CEB. So it talks about any company which includes even foreign company. So the Form 3 CEB or the international transaction compliances or accountant's report is equally applicable to a foreign company in respect of its intercompany transactions with the taxpayer. For domestic transfer pricing, they have kept a limit right now of 5 crores. So unless you cross that limit of 5 crores, you don't have to kind of file the Form 3 CEB. And generally, Form 3 CEB can be issued by any chartered accountant as long as the is chartered accountant in practice. It need not be statutory auditor, it need not be tax auditor, it need not be internal auditor. So there is no kind of compulsion that only a stat auditor can do it or a stat auditor cannot do it, either ways. So it can be issued by any chartered accountant. Now Form 3 CEB is basically like any kind of audit forms in the income tax act, is divided into two main parts. And this is very similar to the tax audit report. So people who have not kind of come across Form 3 CEB can draw references or analogies from tax audit reports. The form and the format is very similar except the clauses are different. But otherwise the concept wise is very similar to a tax audit report. In tax audit report also the government expects chartered accountant to step in and kind of look at the books of accounts on behalf of the government and certify some of the things. And in Form 3 CEB also they expect a chartered accountant to step in, look at the books of accounts of the taxpayer on behalf of the government and certify some of the things. So your primary duty or primary allegiance is towards the government and not generally to the taxpayer. That is what the government's thinking and the government's thought process was when brought about the Form 3 CEB. So it's divided into mainly two parts. One is the report and the other is the annexure, which is following the report. And annexure also has three parts: Part A, Part B and Part C. Part A talks about very general information about the company like permanent account number and everything. Part B talks about the international transaction, and Part C, which was introduced last year only, talks about the specified domestic transaction or domestic transfer pricing. So it's divided into these three clear parts, and you have to report it according to the transaction where it will fall. Now, these clauses of Form 3CB are also very important. This is a prescribed form, so technically speaking, you can't make any changes to the form. Although till the e-filing was not there, people were, or the chartered accountants were taking liberty to kind of do some minor changes to bring out their own level of satisfaction. If the chartered accountant is not not satisfied with some assertion made in the prescribed form, I'm sure he has the liberty to kind of bring out the differences over there. So while it was a prescribed form, in earlier scenarios I have seen many Form 3CBs where chartered accountant used to customize a little bit by putting kind of relevant disclaimers and everything. Now it is an online filing, you don't have any choice, you have to kind of file that online. It goes straightway, sits on the income tax department website, so you can't do anything, you can't make any changes. For your satisfaction, you can adopt some other means like filing a letter or filing a physical copy, but as per the law, the one which sits on the income tax department website is the right form 3CB and the final form 3CB. So, the main report is divided into 3 paragraphs basically. The first paragraph just says that as chartered accountant, I have examined the books of accounts of the assessee of the taxpayer for the year ended so and so. Very simplistic, saying that I have examined accounts and records of so and so relating to international transaction and specified domestic transaction. Only problem that generally comes over here is in respect of foreign companies. As I said, foreign companies are also required to file Form 3CEB, and for foreign companies, obviously they don't maintain books of accounts in India, and the client won't allow you to go to their home country to verify those books of accounts. So generally, what do you write in such cases? And it is in the earlier scenario, people were writing that we have not examined the books of accounts, or we have examined only the limited set of records or limited set of accounts that have been made available to us, and not the entire books of accounts. Now under the revised scenario, again it's difficult to do any changes. It's a standard form on an e-filing basis, so no changes are kind of possible. But people are still kind of taking a way out in filing a physical Form 3CB or filing a letter saying that because of the issues in e-filing, these are the things which are, as chartered accountants, I don't agree with the e-filing thing, and these are the relevant revised clauses of that. Second thing, what happens generally is that if you are not the stat auditor, then generally people would like to kind of qualify saying that these books of accounts were not audited by me but audited by someone else, and I am relying on that audited set of books of accounts. So this kind of disclaimer also I have seen in Form 3CBs in the earlier years, where people used to put those kind of disclaimers saying that the books of accounts have been examined based on audited accounts audited by XYZ, or audited accounts presented to us that way. And most importantly, what happens is that in case, because transfer pricing is applicable even for kind of 1 rupee of transaction, and you will find scenarios where tax audit not being applicable but transfer pricing being applicable. In those cases also there is no, and if the company is following different accounting year, say if the company is following December accounting year for their statutory purposes, for company law purposes, and for income tax purposes it will be just a management prepared account because there is no audit particularly done for that. So then also people would like to kind of bring their attention to the fact that they are management prepared accounts and not audited per se. So these are some of the clauses that could kind of come across, or scenarios that could come across, even in a very simplistic disclosure like I have examined the books of accounts. The second paragraph talks about what the opinion of the chartered accountant basically. And it talks about that, in my opinion, proper information and documents as are prescribed have been kept by the SEC in respect of the international transaction or specified domestic transaction. So far it appears from my examination of the records of the SEC. So here we are actually certifying whether the company has maintained proper documentation which has been prescribed by the law or not. Now again, a very difficult and very onerous task, because as a chartered accountant, especially if you have not done transfer pricing documentation, and transfer pricing documentation is actually done by the company themselves or by some other chartered accountant, it's very difficult to kind of put a reliance on a documentation not done by you specifically. So you actually have to review the entire documentation and assert whether it's been maintained as per prescribed. And transfer pricing is one subject which I'm sure you would have learned till now and you will keep on learning, is extremely subjective. If I ask for a particular transaction, all the people here, I'll get 60 different arm's length price for a single transaction itself, based on different methods and different permutation combinations. So this is something which is extremely subjective, and it's very very easy to find faults in other transfer pricing reports. At the same time, it is very easy to kind of bring out new permutation and combination. And therefore, for a documentation report to be certified by a chartered accountant saying that it meets with the prescribed guidelines or not, it's an extremely onerous task, and one has to kind of discharge this with fullest responsibility. The documentation requirement is actually prescribed under section 92D. You will be read with rule 10D, where they have prescribed around 13 clauses under which documentation has to be maintained, which includes all kinds of the group details, the ownership details, the transaction details, what kind of business activities the company does, the FAR, the function, assets and risk analysis, the comparable search, the benchmarking search and everything. So kind of an all-encompassing documentation requirement is there as per rule 92D, and as a TP auditor or as chartered accountants, we have to see whether the company has maintained the documentation in line with what has been kind of submitted. There is a kind of a relief over here. The rule 10D, section 92 says that if the intercompany transaction volume is less than 1 crore on the international tax side or the international transaction side, and on the domestic side less than 5 crores, then you need not maintain prescribed documentation. But while giving the relief, it's actually a hardship more than the relief, because what after relief they have said they have put a proviso saying they provided the SSC maintains, or the taxpayer maintains adequate documentation to satisfy the transfer pricing officer. So again, you are kind of completing the same circle, because transfer pricing officer would not be ever satisfied with the set of documentation that you maintain. So it's the same story again. While they have given a relief below transactions below 1 crore, actually per se there is no relief. So if your case gets picked up for a scrutiny even by a assessing officer, or it gets referred to a transferring officer, documentation not in the prescribed form is going to attract scrutiny in a more detailed manner, and the officer is just going to frown upon saying that it's not in the prescribed format. So practically, to my mind, and whenever I advise my clients, this limit is just there for the sake of that being there in their statute book, otherwise it has no meaning for it. And in those cases where if the prescribed documentation is not maintained by the company, the owners and the responsibility is on the chartered accountant more to satisfy whether adequate documentation has been maintained or not, if not prescribed. At least prescribed is very simple, that XYZ things are prescribed and you do a check kind of a thing, then all this has been done. But in adequate, there is no definition of what is adequate documentation. And this is the last assertion that is required in the form 3CEB, saying that the particulars that are required to be furnished under section 92E are given in annexure. So as I talked, there are annexure, and annexure has 3 parts. And to the best of my information and according to explanation given to us, the particulars given in the annexure are true and correct. So again, you have to kind of look at this. The words used are true and correct, not true and fair. Generally, you come across true and fair when you are auditing books of accounts, everything. But here it's true and correct. So it has to be factual accuracy is most important. The numbers that are reported in Form 3CB, the associated enterprise name, etc., has to be factually correct, because you are giving an assertion that they are true and correct. Again, foreign companies, the issue would come because you do not have all the information, so you have to kind of declare your incapacity to say that we don't have so much information, or we don't have XYZ information, or not all information is available. And I feel again the certification part of the Form 3CB, I feel is extremely dangerous for a chartered accountant, because it requires you to kind of certify true and correct, and which means that you need to do 100% checking, because true and fair can kind of give you the materiality concept, and you can kind of get away with minor mistakes in the books of accounts. But true and correct will not let you go even if there is a error of 100 rupees in the books of accounts or in reporting the international transaction. So somewhere I feel that people or chartered accountants in the past have taken liberty and can take the liberty to say that this is based on test check or some kind of a disclaimer to say that you're not done 100% checking of the books of accounts, because for multinationals which have business running in thousands of crores over here, it's virtually impossible to kind of go through a ledger account and go through the international transaction, each and every entry for determining true and correct view of the matter. Then we talk about the annexure. And annexure, as I mentioned, are divided into 3 parts. Part A talks about very general information. I'm not going to kind of spend time anything on this. Name, address, government account number, nature of business, your assessment year, and value of international transaction and value of domestic transaction. Nature of business or activity is the pre kind of design fielding code. You have to take the code from the code that are defined in that form ITR 6, which are behind those forms. Those codes are there for each and every activity. So same codes should appear over here. Clause 10 asks you to kind of list down what are the associated enterprises. And you basically are supposed to write down the name of associated enterprises, nature of relationship with associated enterprises, and brief description of the business activity of the associated enterprises, not the company, because company has been covered in earlier clause 4. So clause talks about brief description of the business activity of the associated enterprises. So again, issue comes up over here, the standard issues that generally come. So I'll not go through the kind of each and every clause of the form, because some of these are very self-explanatory. What I'm going to do is that raise what are the issues that are arising. So what happens if there is an associated enterprise for the part of the year? You acquired a company on 29th of March and that company became an associated enterprise for 3 days, or somewhere during the middle of the year. What do you report it as an associated enterprise because it was not an associated enterprise during the full year, it was only for the part year. Generally you should report it as an associated enterprise because the definition of associated enterprise itself talks about at any time during the year. So even if it's for 1 day, you have to report it as an associated enterprises. Maybe you can put a note to that effect saying that it was only for a day.
But transaction activities ended during the whole year. Was the transaction ended before the relationship also needs to be reported?
Technically yes, but people, my experience is that we don't put the transaction before a relationship and disclose in a note saying that these are the transactions only after this date, after a relationship was established. There are transactions prior to that which are not reported here. So from a disclosure requirement, I believe that every disclosure should be there on the table of the officer to kind of, for him to take a call. At the same time, we have to balance it out, because sometimes if you report all the transaction, the worry is if it exceeds 15 crores, scrutiny mein chala jayega and all those stuff. So you try and balance out the things, but disclosure should be there to the fullest extent.
But technically, this is not an international transaction if...
No, because at that time the AE relationship did not exist. So if you go into that, the actual reading of the law, it talks about that once an associated enterprise is any time during the year. But international transaction is with an associated enterprise. So if you go it extremely legally, it will say all transactions are getting covered, even before a relationship existed. But then it doesn't make sense for the officer to look at that arm's length price, because it was always at arm's length, because the relationship was not there at that point in time. And therefore people kind of try and balance this out. It becomes extremely difficult if you are dealing with multinational corporations, which you have to do in transfer pricing, to get a group shareholding. They say some of this is confidential, some of this is not available, etc. Why group shareholding is important is because you will know your immediate parent company or the ultimate parent company, but you don't know how the relationship is there with the other sister companies. And if you see the clause, you have to disclose the nature of relationship with associated enterprises, whether in what clause it falls. Clause A, clause B, clause C, there are clauses A to M. So under what clause it falls, you need to disclose that. So sometimes if the group is not ready to kind of disclose the entire group structure to you, because probably India is only 0.5% of their global turnover and they say India does not count for us and therefore we will not share all these details. You have to kind of mention that although we understand they are group companies, we don't know the exact shareholding pattern. So you have to kind of qualify your report or kind of put those disclaimers in place wherever you don't know the group structure. You just can't say that they are kind of associated enterprises without mentioning the under which section it falls or under which clause it falls. Again, business of the associated enterprises becomes very difficult to verify. You have to go by what the management says. You can do a kind of a a sample check by looking at some kind of a company law document in that country if it is available, which talks about business or the website, etc. But otherwise, you do just go by what the management says. The clauses 11A, 11B, and 11C talks about transactions in tangible property, and whether you dealt with in or purchased or sold. 11A talks about raw materials, consumables. 11B talks about finished and traded goods, and 11C talks about other tangible, movable, immobile property. So this is what you need to disclose here in this clause. Again, questions come up: what happens to goods in transit? Are they actually purchases or not? Whether you are on the sales side, whether you disclose them or not. Again, the same principle I would apply, that disclose whatever knowledge is available to you or whatever information is made available to you. If it's goods in transit, disclose it by way of a note saying that this is goods in transit. Do you kind of disclose it gross or net of excise duty? Again, is a question. Again, there are no straight answers to it. I may disclose it as gross, someone else may do it as a net. But I think whatever you do, you put a note to that effect saying that this is gross or this is net. So at least the officer knows that you have done it and so manner, and if he wants other details, he can always ask for it. In purchase of goods, I have seen many times that people report in amounts including freight, including customs and everything. Personally believe that's not the right practice because custom duties, freights, etc. are a fallout of the purchase transaction, but that amounts are not being paid to associated enterprises unless it is a CIF purchase. But otherwise, those amounts are paid to some forwarding agent here in India, to Indian government as custom duties. So that amount should be reported as net, kind of net purchase value which you are going to pay to your associated enterprise. Because what you need to determine is the arm's length price of the transaction, which will be equivalent to purchase price. Custom duties and forwarding are just a follow part of that. Foreign exchange, again, big issue. People report either net of foreign exchange. Sometimes people give effect of foreign exchange in purchases, sometimes in sales, etc. Foreign exchange again is an effect of the transaction. Per se transaction doesn't get kind of affected, the arm's length price would not get affected because of the foreign exchange. You have to disclose what is the amount that is payable or receivable from the associated enterprises rather than after giving effect to foreign exchanges. I have also seen sometimes Form 3CBs because it does not kind of talk about how to disclose invoice-wise details given in Form 3CB. Invoice 1, invoice 2 as a full-fledged annexure to the entire sales register or purchase register is a part of Form 3CB. You should try and avoid that because what they require is only a summary information. What is the aggregate value of the transaction with on purchase side, on sales side with XYZ associated enterprises. Clause 12 talks about transactions in intangible property which will be mainly on the license, on the royalty side or the know-how side. It's either licensing of it or the outright purchase of it. And clause 13 talks about services. Again, either availing or rendering the services. Again, same questions would come up in terms of whether it should be net of service tax or gross of service tax, because when you render services, you typically tend to charge 100 is the invoice value plus 12 rupees service tax. You charge entire 112 to associated enterprises. You debit the associated enterprise with 112, not the 100 amount, because you are going to recover that 12 rupees from the associated enterprise. Should you disclose that 112? Again, there are multiple views prevailing. My personal preference would be to disclose only 100 because lower the value of the transaction, better it is. Kind of does not attract any suspicion. But if you disclose 100, please disclose the fact that it is net of service tax and the service tax is not being reported about that way. So, idea is that you should disclose whatever is the value according to the arm's length pricing, what you are going to derive at the arm's length price. The consequent effect of that in terms of service tax, excises, or what withholding taxes, etc., should not be disclosed.
And what about the advances, like debtors outstanding and advances, like advance from share capital?
We'll come to that. Those clauses are there again. But these are pure rendition of services. So if you have just received an advance,
services provided free of cost.
Services provided free of cost also should be reported because it talks about rendition of services. Does not say whether the price has been received or arm's length price has been received or not. So that also should be technically reported over here.
Value will not.
Value will not come, and someone has to ascribe a value to the arm's length price. If you believe the arm's length price is 0, it is fine. But otherwise, if the arm's length price has to be put, that number has to be put there.